Thank you and welcome to this special panel, which is a part of the Bloomberg Canadian Finance Conference. And our topic is the use of leverage in the public sector. Leverage has been utilized in public sector entity balance sheets for years, but more recently, debt issuance has increased. Are there limitations to the leverage one can employ prior to impacting ratings? We will discuss these ideas and questions in a roughly 20-minute conversation. But first, as for a quick intro, I am Abigail Doolittle, markets correspondent and segment host for Bloomberg Television. I've been with Bloomberg Television almost for 7 years now. As for our esteemed panelists, we are fortunate enough to be joined by Ian Charest, Senior Director, Treasury, CDPQ, and Brandon Weening, Senior Vice President, Corporate Finance, OMERS. So both Ian and Brandon are within the higher ranks of two of Canada's largest pension plan asset managers and are in a great position to offer color on the use of leverage in the public sector. Before we talk about this important topic, I'd like for both Ian and Brandon to introduce themselves, along with providing some broad background on both OMERS and CDPQ in about a minute or so each. Brandon?
Sure. Thank you very much. My name is Brandon Weening. I've been with OMERS now for 8.5 years in a variety of roles, and most recently into a finance role that has brought oversight of our consolidated financial reporting externally, as well as the financing program that we're here to talk about. And recently, I've also taken on finance leadership of our capital markets business, which is about half of the balance sheet. OMERS is one of Canada's largest defined benefit pension plans. We invest on behalf of and to provide pensions for the municipal employee workforce here in Ontario. About 550,000 members are part of the OMERS plan, being active, retired, and deferred. And our assets at the end of June 30th of this year were about $120 billion. We invest across the globe in real estate, infrastructure, private equity, and of course, the capital markets businesses themselves.
Wow, very impressive. Ian?
Well, thank you for having me. Ian Charest, I'm in charge of the Treasury team at CDPQ, and my team is responsible for CDPQ's funding programs, liquidity management. I've joined the organization 10 years ago. Before that, I spent roughly 10 years working for a financial institution in a somewhat, I would say, similar mandate. Now, for CDPQ, we were created by the government a few years back, in 1965, to act as the exclusive asset manager for public and per-public organization in Quebec, and in Quebec only. So these organizations are mainly pension funds serving public sector employees, for example. But there's other types of organization as well. But again, we serve only government-related per-public organizations. We have more than 45 clients. 8 of these clients account for more than 95% of assets we manage. So we have a bunch of smaller clients at the municipal level, for example. So as it is the case with OMERS, we're a pretty large institutional investor. We have a global presence. More than 75% of assets under management are actually outside Canada. One thing I need to mention is that we are fully independent from the government as well. So we were created by the government, but we act completely and fully independently. So there's no involvement from the government in anything we do, basically. And one last thing, we have a dual mandate. So we need to optimize returns for our clients, of course, but we have to do that while contributing to Quebec's economic development, especially the private sector, which does not come with any kind of, specific, explicit threshold of amount we need to invest in Quebec. It's really more about, using our expertise and network to support these companies.
A dual mandate. We hear much about dual mandate. So just to bring this home a little bit more in terms of the people that you're really serving a bit more, you're talking about teachers, firefighters, nurses, I'm assuming. Is that true, Brandon? And if it is true, I think it is true. There's a lot of trust involved. Talk to us about that before we move to the topic of leverage, because after the financial crisis of 2008, the word leverage, it sounds a little bit ominous and maybe not exactly congruous with teachers and firemen and policemen.
Sure, I'll talk a little bit about the members as you suggest. So, not teachers actually. In fact, in Ontario, there is a separate pension plan for teachers. It's called Ontario Teachers Pension Plan. I'm not here talking about them. I'm talking about the Ontario Municipal Employee Retirement System. So, yes, police and firefighters, paramedics, but as well as librarians, municipal workers, so in parks and recreation or in the city hall and civil service, of course, and then non-teaching staff who work for school boards. So that would include librarians and custodians and administrators as well. And so your question was around leverage. I would say, we use leverage prudently, and it's part of our investment beliefs to use leverage prudently to enhance the investment returns that we are trying to earn. Of course, we take the contributions from the members and accumulated earnings, and we invest them in assets across the globe. So we do use leverage prudently to enhance the investment returns, particularly as we invest in assets outside of the capital market, so in infrastructure and real estate specifically.
So you're using that word prudently, which sounds like a good fit in terms of speaking of these important Canadians, the firemen and policemen and paramedics and such who are really trusting you. In moving this conversation along to the investment process, can you talk a little bit about that investment process within CDPQ before we talk about leverage, layering that leverage onto the investment process?
Sure. Well, when it comes to the investment process, since we have more than 45 clients, the investment process starts with building an investment policy for each of these clients. They all have different risk appetite because they have different goals and needs. So we need to work very closely with them in building that, I would say, high-level investment policy. And so with that, we have long-term asset allocation targets that we can use to build, first of all, I would say, core investment orientation. So we have we call them investment pillars, including, for example, diversifying and maintaining a global presence, for example, or focusing on sustainable investments, to take that example. So when we have these core investment orientations, now what we do is that we are actually building what we call specialized portfolios. These are really strategies for each of the main asset classes we manage. So our clients, our 45 plus clients, ultimately, they own units of each of these 8 specialized portfolios. So we have a specialized portfolio for real estate, for public equity, for credit, for example. So that's really how we optimize returns, how we add value for our clients. It's really about building the best strategy, building the best portfolios, and also applying overlay strategies. So beyond these 8 specialized portfolios, there's really cross-sectional overlay teams that can add value, whether it's, for example, teams that will be focused, as I mentioned earlier, on sustainable investment, on technology, for example. So that's pretty much, in a nutshell, how we're managing our investments.
So it sounds like a lot of little hubs with 45 spikes going out. I may not be seeing that exactly right, but it certainly sounds like a complex process. Before we turn back to Brandon, if you could very quickly talk to us about now, how does leverage work? Because I think it's a little bit different than it is at OMERS. I think that your Treasury is actually seen as a bit of an internal bank to these specialized units, and they have to apply for the leverage, so to speak.
Indeed, it is. Okay, yeah, all organization have its model adapted to its reality, of course. But yes, at CDPQ, we act, as you said, as an internal bank. So we actually have, internal transactions, and these transactions are governed by a robust framework, risk framework. But the thing is that we really have to work very closely with each of these investment units we lend to in, putting in place a funding plan that makes sense. And also makes sense on an aggregated level, basically, for the whole organization. So there's a lot of collaboration on a daily basis. Absolutely.
And Brandon, is it as complex there at OMERS relative to both the investment process and then the process of leverage, providing leverage to those different units?
So the asset and investment process, it all starts with our liabilities from, and every couple of years we do an asset liability study to determine the optimal asset mix that we'd like to invest in to achieve the pensions objectives. We most recently completed one, I believe, earlier this year. That sets our long-term target asset mix. And then we continue to deploy capital towards that long-term target asset mix by asset class and including by geography to meet the expected returns over the long term. And that's something I will emphasize here is we are long-term investors. Our youngest member, she's 17. Our oldest is 107. That's a 90-year relationship we have with some of our members, or ostensibly. And so that is the perspective that we're trying to maintain there. In terms of how we actually use the leverage, it's a little bit like the way Ian's described for his institution, but in fact, we do it in one of two ways. There are certain projects and certain assets where it makes sense for us to put in debt capital directly with the OMERS guarantee. And so that might be a development project in real estate or elsewhere where we will loan the proceeds into the investment, a wholly owned subsidiary of OMERS. There are other instances where we will take the proceeds of our leverage and fungibly add it to the rest of the liquidity capital that we have at the enterprise and just use it to fund our equity investments wherever they be across the enterprise.
Got it. And so bringing this back to your members, those hardworking Canadians, let's talk about that word prudent again. Ian, I understand that you, and I know that, or I believe, Brandon, OMERS as well, you're both guided by boards in terms of prudent responsibilities and standards. What is the cap in terms of the amount of leverage that you're allowed to use? Do you usually hit it? What kind of guidelines, what kind of constraints do your boards put on you? And Ian, I guess if you'd like to start with this question.
Yeah, sure. One thing I can say before is that, leverage for us is not really about necessarily increasing risk. And that's the first and pretty normal reaction when you talk about leverage. You really think about an existing portfolio or an existing asset, and then you put leverage on that. And so you increase risk and you, of course, increase expected returns. For us, leverage is really about getting more options in terms of portfolio construction. So really about selecting the right assets so we can tailor, if you will, with that tool we have, this senior debt program, we can tailor investments a little better. We can, for example, reduce exposure to some high volatility assets and buy low volatility assets with some internal leverage. So you may end up with a better, more diversified portfolio. So I wanted to just clarify that leverage is not necessarily about increasing risk. As for the framework, the governance around usage of leverage, yeah, it's pretty strict. And I need to say, well, overall, yes, there's some level of issuance on the market that you may see, but compared to our net assets, it's pretty low. In fact, we have a senior debt ratio that is under 7% as we speak. So very limited compared to the amount of assets, the quality and liquidity of these assets as well. So there's a commitment at all level in the organization to maintain that low level of leverage and, of course, to maintain the AAA rating.
At OMERS, so Brandon, you share the need to have that AAA rating, I believe, and if I remember correctly, the cap is 10%, but something that seems a little bit different perhaps from CDPQ, and it's really interesting, Brandon, that use of leverage for that diversity, especially in such a volatile year, 2022, it seems as though any kind of hedge is probably a good one. But you guys are actually looking for a little bit of extra outperformance, Brandon, is that correct? And if so, how much?
Yeah, so we do, it's like I said before, we do use financial leverage prudently to enhance our investment returns because we are rated AAA by 2 institutions and then 1 notch below by 2 other institutions. Obviously, the spread that we can get for the debt is cheaper than what an individual investment might be able to get. And so even just on that interest rate differential, we're able to take a bit of a pickup. Now we do have a risk appetite that would limit our leverage at this level to about 10% of the plan's net assets. That is in a board-approved policy. It's considered by the credit rating agencies, as you suggest, many of them comfortable with that in awarding us the ratings that they have awarded us right now.
And so one of the roles that both of you have, or it strikes me that you have, is really as a marketer, essentially going out to some very sophisticated investors in the world, including some of the smaller central banks. Ian, could you talk to us a little bit about the types of investors that you are marketing to, where they are geographically, and to the degree that you're able to identify them, just to give us a sense, give our viewers a sense of who who's interested in this debt and why?
Well, what's interesting, I think, is that the Canadian pension industry in the last few years has carved out a place, if you will, on one specific subsegment of funding markets is the SSA market. It stands for supranational sub-sovereign agency market. So you have there large agencies like the World Bank or Asian Development Bank, or in Europe you have KfW in Germany. So most of them are AAA rated, of course, and they have a very low cost of funds when you compare to sovereign debt like U.S. Treasuries or German bonds. So it makes sense for issuers like us to make efforts to make sure we're recognized as an issuer on that market. So the type of investors we'll target is the same type of investors they're targeting. So you will find, as you mentioned, you'll find some central banks and official institutions there. So that's a bit different from a corporate market. So that's the type of investors we're chasing because they're very stable, loyal. Once you have them, and once they approve your name, they will come back and they buy your debt. But you will find, of course, asset managers, private asset managers, bank treasuries, insurers, pension funds, and of course other type of investors.
And so ultimately, one of the reasons that this debt that you both are issuing is attractive to these investors is it's a little bit above the Canadian benchmarks. You get a little extra return. And while you're not truly government bonds, you're pretty safe. Is this true, Brandon? And what are some of the questions that these investors ask you on the road? Well, back in the day, and we'll be talking about this in a moment, but also over the Zoom screen, I'm imagining.
Sure. Yeah. Their motivation for investing in OMERS term notes is exactly as you described. Yes, we are AAA or one notch below, and we pay a little bit more spread than the true sovereigns like the government of Canada or I mean, for us, we're actually targeting US dollars as our core currency, and of course, paying a little bit more. Still a spread that we're comfortable with relative to the long-term investment returns that we're earning on our assets for sure. And so we're able to find a middle ground there, so to speak. Some of the questions that these investors do ask us when we used to go on the road, and as you say now on Zoom, one is about the relationship to the province of Ontario, and Ian talked about it for his institution, the Independents. We similarly are independent from the province of Ontario. We have the exclusive mandate to be the pension provider for the municipal employees in the province of Ontario, but we operate independently of them. They also ask about our asset base, our diversification, and our strategy, and they ask about really the funding program itself. How frequently do we anticipate coming to market? What currency, right, what tenor, et cetera.
Well, in our remaining 60 seconds or so, we are, of course, here in the U.S., we have been told by President Biden that the pandemic is over. However, many of the effects of the pandemic, not so much. So I understand that one of you prefers these new trends of working from home, and one of you is very, very excited to be back on the road. Can each of you tell me in about 20 seconds or so what your experience is? Ian?
Well, in terms of getting the message out and engaging with investors, I think it's of course pretty useful. Having access to virtual meetings, I think today it's more widely accepted by investors. In the beginning, it was not that obvious,
right.
But but now, mixing that with in-person meetings is also important. I need to to specify that. Yeah, I think there's a value in in-person meetings as well. Yeah.
A balance. Brandon?
Yeah, in terms of our work here at OMERS, we're coming back to the office more often than not, and I think that really helps build and strengthen the culture that we're looking for in terms of investor relations. Happy to do either. I would say if there's a concentration of investors, we're more than happy to make a trip wherever they are across the world, as long as the cost and the time makes sense. Happy to meet them.
Great.